how to calculate the right leverage. Now don't be afraid of these notes. This is not a mathematics class, but we sure will be discussing some basic mathematical concepts. So, let us consider that your account size is $100 and you're able to risk 1% of your account size. That means you're able to risk 1% per trade. So what are the defining factors to know the right leverage? First is your position size, that is without leverage, and then your exit or your stop loss. So we already know our position size without leverage here. Okay, so suppose you put in $10 per trade. So let us have a look at setup number 1. You take entry in a trade where your take profit is 2% above your entry price and your stop loss is 1% below your entry price. It's a very basic concept to calculate your R2R, that is risk to reward ratio. Risk 1, reward 2, so 1:2. Now your risk appetite per trade is $1. As you can see here, risk 1% of account, that is $1 per trade. This means that you can take a 1% loss if it equates to $1. And you can take a position size of $100 and take a 1% loss on it. So required leverage here is 10x. How? You multiply this $10 to the 10x leverage and you get what? $100. So if you take a 1% loss on $100, you only lose $1. Okay? In the same case, if your stop loss was 2% below entry and take profit 4%, again R2R is 1:2. This means that you can take a 2% loss if it equates to $1, correct? So you can take a position size of $50 and take a loss of 2% on it. So what will be the required leverage here? 5x. How? You take this $10 that you are able to invest per trade and multiply it by 5 to get $50. Now, we take another condition where your account size is again $100 but you are able to risk 2%. So calculating with 1% is pretty simple. Let's have a look at 2%. So risk is 2% of account, which means you are able to risk $2 per trade. Okay. Again, defining factors will be position size without leverage and your exit or stop loss. So suppose you put in $20 per trade. Last time you were putting in $10, here you put in $20. Your take profit is 5% above entry and stop loss is 2.5% below entry. So now we're taking some not so simple numbers here. Okay, again R2R is 1:2 and your risk appetite per trade is $2, right? This means that you can take a 2% loss if it equates to $2, right? So here, what do you need to ask yourself? You need to ask yourself 2.5% of what is $2? Because you'll be taking a loss of 2.5% and it should equate to $2 only. Okay? So here you use basic mathematics. Now I'm pretty sure you're familiar with the unitary method. It's a very basic mathematical concept. So 2.5% of S is what? It's your total size. Okay? Total size. So 2.5% of S is $2. We can write 2.5 divided by 100 into S is 2. So S is equal to 2 into 100 divided by 2.5. What did we do? We shifted these numbers here, right? Is equal to 200 divided by 2.5 and 2000 divided by 25 is equal to 80. Now $80 divided by $20 is 4. So your required leverage is 4x. So I'm pretty sure as beginners, this video is going to be really helpful to you guys to really understand and take the first step towards leverage trading or margin trading, because you really need to know how much you're willing to lose per position and accordingly you need to set your leverage. Alright, so if you want, you can take a screenshot of this and study it again or just watch the video again. It isn't really a lengthy one, but I'm sure it's going to be helpful. So that is all. So I'll see you guys in the next video where we will be discussing who should trade using leverage and who should not. Till then, take care. Cheers.